Welcome to another edition of Fireside Financials. Today we are going to talk about marginal versus effective tax rates. I know this is the one you all have been waiting for because this is the most exciting topic you've ever heard in your entire, can't even pretend. But this is actually really important. And the reason being, not just because we're really close to tax time, but in conversations that I have with small business owners, this is a big fear of theirs, which is a misunderstanding around how taxes are calculated. And so they have fear around earning more money because it will put them into another tax bracket and really bump up the amount of taxes that they owe. So let's go ahead and dismantle this one, or at least talk about the differences so you can better understand what they mean and how they impact you. So first, what is the marginal tax rate and what is the effective tax rate? So quick little backstory, I'll make it really quick. The US has a progressive tax system. That means if you earn less money, you are taxed at a lower rate. And the more money that you earn, the more taxes that you pay, at least for earned income. And so, for example, if you earn $9,500 a year, you'll be taxed at a federal rate of 10%. Or if you make, let's say, $89,000, you're taxed at a federal tax rate of 22%. So what the marginal tax rate means is that's the rate at which the next dollar that you earn is taxed. So for example, if I'm in the 22% tax bracket, then the next dollar that I earn is taxed at 22%. And if, for example, I'm right at the line between like the 22% tax bracket, 29% tax bracket, the last dollar I earned was at 22%, but the next dollar I earned is actually at 29%. So it has these kind of very delineated tiers in the way in which your money is taxed. And this then leads into what your actual effective tax rate is. Because while my next dollar may be taxed at 22%, the average rate that I'm taxed, across all of my earned income is going to always be a lower rate. So for example, if you earn, let's say, $75,000 a year and you're in the 22% federal tax bracket for your marginal tax rate, your effective tax rate is going to be less because the first $10,000 of your earnings is taxed at 10%. The next 30 is taxed at 12%, I think. And then, from 40 grand through 85 grand, it's taxed at 22%. So this is where that myth stems from, of people being worried that when they get pushed into a higher tax bracket, what they've heard is that all of their income will now be taxed at that higher rate. So everything from zero to hypothetically, the $80,000 they earn would be taxed at that new rate of 22% versus just the next dollar, which is the marginal tax rate. Hopefully I haven't confused the crap out of you, because I know those are some small differences, but it's really important because there have honestly been a lot of people who are worried about earning more income. Talked to someone recently who wasn't taking on new gigs for fear of how much that would then cost her in taxes, right? And so it's a very real fear, and it's something that's very misunderstood and isn't certainly, I'm just gonna lounge here if you don't mind by the fire, that is widely misunderstood, and I think we need to do a much better job of explaining how the tax system in America works, which again, not super exciting, but hi, that's what I'm here for, to help take the complex topics, make them more digestible, more sexy, and easy to understand. So in terms of what then, how to use that come tax time, there are some great tax calculators out there, actually. I'll see if I can put one in the comments. It's called the Smart Asset Income Tax Calculator. And if you put in how much money you expect to earn, what state you live in, and any deductions or exemptions that you have, it will show you both what your marginal tax rate is, what the next dollar is taxed at, your effective tax rate, which is the average tax rate across all your income, and it will also show you how different taxes are broken down. So it'll show you based on federal taxes, which is everything we've been talking about so far, but there are also state taxes in some cases, or city taxes in some cases for income tax. So that's a really, really helpful tool to help you get a sense of what the difference between those two are, and also just the different amount of taxes that you might owe in any given year. So that's it. I hope it was helpful. If you have any questions, things that I didn't touch on or you would like clarified, just put them in the comments below and I'll get back to you. And for those of you who are wondering, The smoker's jacket that I was going to have in these episodes is still about 2 weeks out, unfortunately. I think I ordered it from somewhere halfway across the world, so that should be here shortly. But in the meantime, I've got my flowery bonobos shirts, my awesome gold chain with my golden frog talisman, and we'll keep these Fireside Financial episodes coming at you until the wardrobe change.